Audit of NBFC. What is meant by NBFC? RBI Act 1997 defines NBFC as a financial institution, which is a company, a non-banking institution, which is a company with principal business of receiving of deposits or lending in any manner. Such other non-banking institution as RBI may specify by notification in official gazette with previous approval of central government. Registration and regulation. A company will be treated as NBFC when a company's financial assets constitute more than 50% of the total assets, excluding intangible assets, and income from financial assets constitute more than 50% of the gross income. Company which fulfills both these criteria shall qualify as NBFC and would require to be registered as NBFC by RBI. No NBFC shall commence or carry on business of NBFC without obtaining certificate of registration issued by RBI and having net on funds of 10 crores, 2 crores for some NBFCs. In case of NBFC P2P, NBFC AA, NBFCs with no public funds and no customer interface, the net on funds shall continue to be 2 crores instead of 10 crores. For other NBFCs, 10 crores. For these three categories, it will be 2 crores. Net on funds will be 2 crores. Companies incorporated under Companies Act and desirous of commencing business of NBFCs can apply to RBI in prescribed form for registration. What is the difference between banks and NBFCs? NBFCs lend and make investments, and hence their activities are similar to banks. However, there are few differences between NBFCs and banks. NBFCs cannot accept demand deposits. However, some NBFCs can accept term deposits. NBFCs do not form part of a payment and settlement system and cannot issue checks drawn on it. Deposit insurance facility is not available to depositors of NBFCs unlike in banks. There will be no minimum exposure to priority sector required by NBFC. Next, types and classification of NBFCs. NBFCs registered with RBI are categorized as follows: deposit and non-deposit taking NBFCs, non-deposit taking NBFCs, but their size into systematically important and non-systematically important, NBFC NDSI and NBFC ND. By kind of activities they conduct, type of NBFCs in this category are investment and credit company ICC, infrastructure finance company IFC, systematically important core investment company, infrastructure debt fund, non-banking financial company, microfinance institution, non-operative financial holding company, asset finance company, investment company, loan company, etc. Classification of NBFCs. NBFCs are classified into 4 layers. These layers are NBFC base layer. It comprises of non-deposit taking NBFCs below asset size of 1000 crores. Next, NBFCs middle layer. It consists of all deposit taking NBFCs irrespective of asset size. Non-deposit taking NBFCs with asset size of 1000 crores or more. NBFCs undertaking following activities: infrastructure finance companies IFC, core investment company CIC, infrastructure debt fund IDF, and housing finance company HFC. NBFCs upper layer. It comprises of those NBFCs which are specifically identified by RBI. NBFC top layer. It will ideally remain empty and will be filled by RBI based on required need. Categorization of NBFCs carrying out specific activity. As the regulatory structure envisages scale-based as well as activity-based regulation, the following prescriptions shall apply in respect of NBFCs: NBFC P2P, NBFC AA, NOFHSC, and NBFCs without public funds and customer interface will always remain in base layer. Next, NBFC D, CIC, IFC, and HFC will be included in middle layer or upper layer and not on the base layer, not in the base layer, as the case may be. SPD and IDF NBFC will always remain in middle layer. Remaining NBFCs, that is ICC, MFI, and MGC could lie in any one of the layers of the regulatory structure depending on the parameters of the scale-based regulatory framework. Government-owned NBFCs shall be placed in the base layer or middle layer as the case may be. They will not be placed in upper layer till further notice. Next, all references to NBFC ND shall mean NBFC BL, and all references to NBFC D and NBFC NDSI shall mean NBFC ML or NBFC UL as the case may be. However, existing NBFC ND SIs having asset size between 500 crores and below 1000 crores, except those necessarily featuring in middle layer, will be known as NBFC BL. Next, companies exempted from a registration under RBI. Following NBFCs have been exempted from a requirement of registration under Section 45IA of RBI Act 1934, subject to certain conditions. Housing finance institutions regulated by National Housing Bank, merchant banking companies regulated by SEBI, stock exchanges regulated by SEBI, companies engaged in business of stock broking, sub-broking regulated by SEBI, venture capital fund companies regulated by SEBI, Nidhi company regulated by MCA, insurance company regulated by IRDAI, chit company regulated by Chit Funds Act, and specified microfinance companies, securitization and reconstruction companies, mutual benefit companies, core investment companies, alternative investment fund companies, core investment companies with asset size of less than 100 crores, and those with asset size of 100 crores and above, but not accessing public funds, are exempted from registration with RBI. Next, classification of fraud by NBFC. Misappropriation and criminal breach of trust. Fraudulent encashment through fraud involves misappropriation and criminal breach of trust. Fraudulent encashment through forged instruments or manipulation of books of accounts. Unauthorized credit facilities extended for reward. Negligence and cash shortages. Cheating and forgery. Irregularities in foreign exchange transactions. Any other type of fraud not coming under above heads. Cases of negligence and cash shortages and irregularities in foreign exchange transactions are to be reported as fraud if intention to cheat is proved, except following: cash shortages more than 10,000 and cash shortages more than 5,000 if detected by management or auditor and not reported on occurrence by person handling cash. So these frauds need to be reported. In this monetary frauds, intention to cheat need not be proved. Even if there is intention or unintentional also, they need to be reported. Next, prudential norms, capital requirements. Every NBFC shall maintain minimum capital ratio consisting of Tier 1 and Tier 2 capital, which shall not be less than 15% of its aggregate risk-weighted assets. Tier 1 capital shall not be less than 10% at any point of time. Value of each asset requires to be multiplied by relevant risk weights to arrive at risk adjusted value of assets. Percentage of risk weight assets assigned to assets are cash, bank balance, investment in approved securities, fully secured loans and advances, loan to staff, TDS, advance tax, interest on government securities, central government guaranteed claims, weight is 0%, investment in bonds of public sector banks, state government guaranteed claims, not in default or in default up to 90 days, 20% weight, infrastructure projects in existence over a year of commercial operations, 50% weight, others 100%. Provisioning requirements. Every NBFC shall make provision against loss assets, doubtful assets, substandard assets, and standard assets as follows. Loss assets, provisioning percentage 100%, doubtful assets, unsecured 100%, secured if doubtful up to 1 year 20%, if doubtful up to more than 1 year to 3 years 30%, if doubtful more than 3 years 50%. Substandard assets 10%. Substandard assets provisioning percentage is 10%. Standard assets, non-systematically important non-deposit taking 0.25%, others 0.40%. What is meant by NPA? NPA shall mean an asset in respect of which interest has remained overdue for a period of 6 months or more, a term loan inclusive of unpaid interest when the installment is overdue for a period of 6 months or more, or on which interest amount remained overdue for a period of 6 months or more, a demand or call loan which remained overdue for a period of 6 months or more from the date of demand or call, or on which interest amount remained overdue for a period of 6 months or more, a bill which remains overdue for a period of 6 months or more. The interest in respect of debt or the income on receivables under the heading Other Current Assets in the nature of short term loans and advances, which facility remained overdue for a period of 6 months or more. Any dues or on account of sale of assets or services rendered or reimbursement of expenses incurred which remained overdue for a period of 6 months or more. The lease rental and hire purchase installment which has become overdue for a period of 12 months or more. So, in case of lease rental and hire purchase installments, 12 months will be taken, not 6 months. Next, in respect of loans, advances, and other credit facilities, including bills purchased and discounted, the balance outstanding under the credit facilities, including accrued interest, made available to the same borrower or beneficiary when any of the above credit facilities becomes NPA, provided that in case of lease and hire purchase transactions, an applicable NPA NBFC shall classify each account on the basis of its record of recovery. Next, audit procedures. Areas which are mandatorily part of audit procedure for conducting audit of NBFCs, ascertaining business of the company. First step in audit of NBFC is to scan through memorandum and articles of association of the company so as to acquaint oneself with the type of business that the company is engaged to. Second, evaluation of internal control system. Auditor should understand accounting system and related internal controls adopted by NBFC to determine nature, timing, extent of his audit procedures. Auditor should also ascertain whether internal controls put in place by NBFCs are adequate. Registration with RBA. Auditor should verify whether dual conditions relating to registration with RBA and maintenance of minimum net on funds have been duly complied with NBFCs. NBFC's acceptance of public deposit directions. Ascertain whether company has complied with following aspects in relation to activity of mobilization of public deposits. Ceiling on quantum of public deposits is linked to credit rating. Obtain copy of credit rating assigned to NBFC and check whether public deposits accepted are as per credit rating assigned to it. In event of upgrading or downgrading of the credit rating, ensure that NBFCs has informed the same to RBA. In the event of downgrading of credit rating, NBFCs shall stop accepting fresh and renewing existing deposits. All existing deposits shall run off to maturity and report position within 15 days to RBA. Test check interest calculations of public deposits mobilized by NBFCs. Verify deposit register maintained and test check particulars with supporting receipts. Check whether investments made in liquid assets lodged in safe custody with the scheduled bank. Check whether NBFCs has filed returns in timely manner. In case of NBFCs not accepting deposits, check whether board resolution is passed. NBFC's prudential norm directions. To ensure compliance of prudential norms by NBFCs, auditors shall check compliance of norms relating to income recognition, income from investments, asset classification, provision for bad debts, capital adequacy norms, norms for concentration of credit, etc. Ensure that Board of Directors of NBFC shall frame a policy for granting demand loans. Verify loans and advances have been properly classified as standard, substandard, doubtful, loss, and proper provision has been made. Ensure that unrealized income from NPA has not been taken to PNL. Check whether all accounts which have been classified as NPA in previous year also continue to show as such in the current year also. Audit checklist in case of NBFC, Investment and Credit Company, ICC. Verification procedure are points to be covered in audit of ICC, Investment and Credit Company. physically verify all shares and securities held by NBFC, verify whether NBFC has not advanced any loans against securities of its own shares, verify that dividend income is duly received by NBFC and interest is duly accounted, verify board minutes for purchase and sale of investments, verify whether investments have been valued as per NBFC prudential norm directions, obtain list of group companies from management and verify investments made in group companies, examine whether each loan or advance has been properly sanctioned, obtain balance confirmations from concerned parties, check whether NBFC has not invested in excess of specified limits, check classification of loans and advances made by NBFC into standard, substandard, doubtful, and loss assets. Auditor's duty to report matters to be included in auditor's report to Board of Directors of NBFC. In case of all NBFCs, auditors should include a statement on following matters: whether company has obtained certificate of registration from RBI. In case of company holding certificate of registration, whether company is entitled to hold such certificate of registration as on 31st March, whether NBFC is meeting net on funds requirements. Every NBFC shall submit a certificate from its statutory auditor that it is engaged in the business of NBFC, requiring it to hold a certificate of registration under Section 45 IA of RBI Act and is eligible to hold it. A certificate from the statutory auditor in this regard, with reference to the position of the company as at the end of financial year ended 31st March, may be submitted to the regional office of the Department of Non-Banking Supervision, under whose jurisdiction the NBFC is registered, within 1 month from the date of finalization of balance sheet, and in any case not later than 30th December of that year. So last due date is 30th December of that year. That certificate from the statutory auditor need to be submitted to regional office of the Department of Non-Banking Supervision, under whose jurisdiction the NBFC is registered. Next, in case of NBFCs accepting or holding public deposits, auditors shall include a statement on the following matters: whether public deposits accepted by the company are within admissible limits, whether public deposits held by company in excess of quantum of such deposits permissible to it, whether capital adequacy ratio disclosed in written is correctly determined, and whether it is in compliance with the minimum capital adequacy ratio prescribed, whether company has violated any restriction on acceptance of deposits, whether company has complied with prudential norms, whether company has complied with the liquid assets requirements, whether company has furnished return on deposits and quarterly returns on prudential norms to RBI within stipulated period. In case of NBFCs not accepting public deposits, auditor shall include a statement on the following matters: whether Board of Directors has passed resolution for non-acceptance of public deposits, whether company has accepted any public deposits during the relevant period, whether capital adequacy ratio disclosed in Form NBF 7 has been correctly arrived, and whether it is in compliance with the minimum CAR prescribed, whether company has complied with prudential norms. Obligation of auditor to submit exception report to RBI. Auditor has obligation to submit exception report to RBI on following matters: where in case of NBFC, statement regarding any items is unfavorable or qualified, or in the opinion of the auditor, company has not complied with the provisions of Chapter 3B of RBI Act, or NBFC acceptance of public deposit directions 2016, or NBFC non-systematically important non-deposit taking company directions 2016, and NBFC systematically important non-deposit taking company and deposit taking company directions 2016. It shall be obligation of the auditor to make a report containing details of such unfavorable or qualified statements and about non-compliance of company to concerned regional office of non-banking supervision of RBI. Duty of auditor shall be to report only contraventions of provisions referred above, and such report shall not contain any statement regarding compliance of any of those provisions. So only non-compliance need to be reported. Next, difference between Division 2 Ind AS other than NBFCs and Division 3 Ind AS NBFCs of Schedule 3. Presentation requirements under Division 3 for NBFCs are similar to Division 2 non-NBFCs to a large extent, except for the following. NBFCs is allowed to present items of balance sheet in the order of liquidity, which is not allowed under Division 2. NBFC is required to separately disclose by way of notes any item of other income or other expenditure which exceeds 1% of the total income. Division 2 requires disclosure for any item of income or expenditure which exceeds 1% of the revenue or 10 lakhs, whichever is higher. NBFCs are required to separately disclose under receivables debts due from LLP in which its director is a partner or member. NBFCs are also required to disclose items comprising revenue from operations or other comprehensive income on face of P&L instead of as a part of notes to accounts. Separate disclosure of trade receivables which have significant increase in credit risk need to be disclosed. Conditions or restrictions for distribution of statutory reserves have to be separately disclosed. Next, applicability of Ind AS on NBFCs. NBFCs are required to comply with Ind AS as under accounting period beginning from 1st April 2018, listed and unlisted NBFCs having net worth of 500 crores or more and holding subsidiary, joint venture, or associate companies of such NBFCs need to comply with Ind AS. Accounting period starting from 1st April 2019. All other listed NBFCs, unlisted NBFCs having net worth of 250 crores or more but less than 500 crores and holding subsidiary, joint venture, or associate companies of such NBFCs need to comply with Ind AS. The net worth shall be calculated in accordance with the standalone financial statements of NBFCs as on 31st March 2016 or the first audited financial statements for accounting period which ends after the date.